Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You're listening to Money on Tap. My name is Seth Krussman.
And I'm Ben Brayshaw.
We are glad to have you aboard for the ride today. If you're looking for ways to get a hold of us, we're going to get that covered right away. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And something new for you folks, there's a new website out there. It's yourmoneyontap.com, and there is a load of information there for you. So have some fun with that. We can't wait to connect with you there.
Yeah, the website's amazing, Seth. Seth, you know, kudos to you, man. You did a lot of hard work on that.
Well, right back at you. I couldn't have done it without you.
You know, Seth, another thing, too, is for our listeners, too, we just got accepted to iHeartRadio. We're continuing to get picked up by more different venues. So if you do listen to podcasts, we're probably in almost all of the mainstream stuff, which is exciting if you guys have missed an episode or something like that. So
we're going to talk about yield, to yield or not to yield. And
that is the question, Seth. That is the question.
I wish that one of the things I wish that would happen with yield is that when the stocks pulled back, that there was some kind of like a speedometer there that would follow in line, you know, and would track what we could anticipate yield pulling back into, like, because yield is nothing that is, there's no guarantee in yield. It's wonderful if it's producing and if it's there, but we can't certainly recommend anybody doing anything just off of yield.
Well, the thing is yield is becoming such a large conversation because as the value of these stocks drop, the yield continues to rise because they pay on how many shares you get a certain dollar amount. So, you know, if you pay $10 for a share and it's paying $1 share dividend, well, then all of a sudden, if it drops to $5, well, it's like, well, I was able to buy 2 shares for $10, so I just doubled my dividend for the same investment. And that's really the confusing piece right now because people are seeing significant yield, but they don't know if the underlying company is truly suffering quite yet. They know there's a lot of suffering, and there's a lot of stuff to be kind of ironed out, and that's dangerous because these yields may not even be supportable, and they might be cut right around the corner for all we know, or a company could go out of business.
You guys, we are going to have some fun at Money on Tap with you today, and that's one of our guarantees. We don't guarantee returns here, but we're going to guarantee we're going to have a good time, and along the way, you're going to hear what inside a planner's brain. And some of the ideas and the concepts that we're going to work through. The bonus is that you get that for free, and if some of it is one of those, like a lot of the time these ideas are things that you're just like can't wait to talk to us about. That's why we give you the phone number. That's why we give you the email so you can get a hold of us and we can help you out with your plan. What are you going to do? Because you got to take the information, you got to make it work.
Yeah, a lot of the information that's out there, we do a lot of planning shows, and for people who have been listening for years, you're probably used to that. We're kind of taking a break because the market has just been all over the place, and we're trying to help people who are doing some of their own planning and managing to have a little bit of perspective bigger than, you know, their everyday job that's kind of preoccupying them, trying to break out some opportunities and where things are moving and shifting. So we've kind of stepped away from the hardcore planning piece, which is the everyday nuts and bolts, and we're kind of getting into the actual nitty-gritty of the investing side, which I'm excited for today because we have some really interesting things to cover.
Something that's a little different about Ben and myself is we both came into this world. We were birthed into planning. Not a fun ride for us, but we got into planning through the equities side.
Yeah.
I was like a self-taught options trader, super high risk, having a lot of fun in the market, and I just loved it. But I was also missing a piece of me as my soul, which was just really helping people.
If anyone's ever seen a Wall Street movie, dialing for dollars, guys under their desks, that's what Seth did, man. He was hardcore. Seth, I have dragged Seth out of that world, which has been a fun time. If Seth had his way, everyone would be trading options.
Right.
I've had to bring him down to ground level.
And that was one of the things that Ben grabbed me many, many years ago and said, Seth, your heart is way too big for what you're doing right now. And I was grateful for that opportunity. Thank you so much, Ben, because I love helping people and I love interacting and engaging with our clients. And this is a great way for you and I to do this. And I think at some point in time today, we're actually going to talk about what we promised people we would talk about. But before we do that, can we just tell people one more time our phone number, 855-226-8551. You can reach us there, or info@yourmoneyontap. Take it away, Ben.
Yes. Now it's time for Money in the News. Yes. So today, Money in the News, I have an article that's hilarious, and I give this a shout out to my friend Jay Rose, because this may have been him. So Jay Rose, if you're listening to this show, I'm sorry, you may be in jail. Florida deputies arrest a man who's been living out his quarantine on the shuttered Disney World island, telling authorities it felt like a tropical paradise.
I can't imagine why it wouldn't.
Orange County sheriffs found, it wasn't Jay Rose, Richard McGuire on Disney's Discover Island on Thursday. He said he'd been living there since Monday or Tuesday and had planned to camp there for a week. Now, Discovery Island has been closed since like the 90s. So this is some Disney location that's been shut down. I didn't even know about it. This 42-year-old man was caught because he was using their boat buzzing around the island and claims he has no idea, that he wasn't supposed to be there, despite a ridiculous number of no trespassing signs that he had to see and the locked gates that he got through. What do you think, Seth?
Good job. I'm surprised that it wasn't like several families that decided to do this together. Like, we are going to Disney World. You cannot keep us from our Disney vacation, because that was us. We were supposed to be in Disneyland, and you guys took it away from us. Darn you.
How many
Disney.
millions of people are right now saying to themselves, I'm jealous that this guy got to spend a good portion of his quarantine over in Disney. I have met so many people who are supposed to go to Disney now, and they're all angry about it. So, but I heard Disney's opening up is it July, Seth? Is that what the date is?
Well, I want to get a little sarcastic with you on that, because I feel like our governor of Oregon's reopening policies that keep changing every day. Like one day it was July, and then no. That was just a statement so that we get the economic relief from the federal government. We just wanted to put it out there. We're going to go ahead and kind of like start rolling things out a little. I don't know. I just don't know what to tell you. It just changes hour to hour.
Oh man, the New Hampshire governor Sununu, he's off his rocker. I have no idea what's going on here. He's now end of May, but he said that it might be months past that. I just heard that the other day, and I was like, if he's really serious, he's lost it. So.
Unenviable position.
Everybody thinks they are gonna walk all over us. I don't understand it anymore. We've discovered that it's just not as bad as it was, and our prayers are with the people that are struggling with this. But we need to protect those who are going to be struggling because they don't have jobs, and we need to get the world back to work. So. Oh man, it's a tough thing. But hey, I am jealous of McGuire. He was arrested though, and he was thrown in jail for trespassing at Disney. But he's probably the smarter of all the people. I mean, if you had to choose a place to do your quarantine, Disney's the spot. I got to tell you. So, but hey, let's jump to an article that's a little more interesting, a little bit more investment savvy. We have the Fed getting ready to buy in on market-based securities in the ETF side. Something we're historically calling out today that this is something that the Fed has never done before. Bloomberg had an article called Wall Street Game Plans, which ETFs the Fed might buy into in May, by Catherine Greifield. This was back in May 8th, 2020, and this is a historic event. This article is referencing. It's been referenced everywhere in Wall Street Journal, you name it. This type of information, but the Fed's getting in to the ETF space, and we're going to reference. And we're not recommending anything here. We're not soliciting any of these. We're going to talk about ETFs that are listed in this, article, and we're by no means recommending. We're going to talk about an ETF that we also have in some of our portfolios, which we have to disclose for compliance, but we are also not recommending that because it's specific for specific clients and specific needs. So that's something you'd really have to check on with yourself. We're by no means recommending any of these investments.
So in all fairness, all disclosure, a lot of what we're talking about here, yes, historic, it's amazing, but it's already happened, okay? Taking what we're doing here today or what we're talking about, and as excited as we are having these conversations and going and trying to put it into your portfolio or into your plan, not a recommendation. It potentially could be something you want to use, but that's a further conversation. That's a bigger conversation.
Basically, Wall Street has been betting heavily as of late on industrial giants such as 45.5 billion BlackRock's iShares iBox. That's an investment grade corporate bond ETF, LQD as a ticker symbol, and the 21 billion iShares iBox high yield corporate bond ETF. That's a mouthful. HYG.
Well,
two of
Seth, for our listeners, that's one of the things we actually entered HYG a couple of weeks ago, and we think that's going to be a high play potential. I think that's probably one of the modes the Fed looks at. That's one of my bets, and I think ultimately, no matter which one, and I know we have more to talk about, but no matter which one they go into, these high yield bond plays, they're all crisscrossing. All these ETFs know the same information. All these different people. So if if LQD owns some high yield bond X and HYG owns high yield bond X, they both can. So it's not like you might get into one and you don't see a rise in the other, and that's important for our listeners to have in the background. But go ahead, Seth. I'm going to let you.
Yeah. So these are high yield bond plays out there. We're basically funds, ETFs that are buying the high yield space. And this is traditionally known as a junk bond space.
Yeah.
And there's there can be the tendency for people to remember the 80s and go, oh, junk bonds, no way. I'm going to steer clear of those. And historically, they are a more volatile bond because these are corporate bonds. These are not, the treasuries. And, people think sometimes bond equals less volatility or less risk. But it is important for people to understand that this is more risky in the bond world. But these are in ETFs, which is an exchange traded fund. So what does that mean for people? They can buy the exchange traded fund like a stock. They can buy it and sell it daily. Okay, so you're not actually buying the bond individually is one of the things to remember for people, and it's not a mutual fund, so it's not trading at the end of the day like a mutual fund, but it is this basket or this basket of bonds in there. One of the things that they're paying close attention to is the maturity on these bonds, and they're trying to keep them under a 5-year period. So this is giving us they're giving signals. The Fed is giving signals out there. What are they potentially looking at buying? And so the market is responding, saying, "Hey, we can kind of front run this, get ahead of it before they start buying into these, and here's where we think they're going to be buying." And that's what Ben and I've been talking about, and ever since we heard that information come across in our desks, guess what we did? Went out there and positioned our portfolios in places we think are likely to capture some of the Fed's money going in. Do you think they're going to go into one?
No, I think Seth, they're gonna spread it deep. But I mean, can you imagine being the manager of XYZ ETF and getting a call from the Fed being like, "Yeah, we're gonna drop a couple $1 billion with you today."
Just unbelievable.
He just got a pay raise. So, but I do like the IGSB, the short-term corporate bond. I mean, there's definitely some opportunity there, I think, with time periods, but sometimes that can be shorter than 5 years. So you gotta figure out how they're going to play this, and are they going to go into a longer term ETF for stronger hopes in case they have to be in longer? even though they're saying they're looking for a 5-year period, is a lot of like weighing back and forth of how is the market going to play this thing out, and how is the Fed going to, try to get their return. And this is a historic scenario. And for our listeners, like, why bonds? Why are they doing bonds? And I think we touched on this briefly last week. But, when you think about when in 2008, 2009 happened and our government started, bailing out companies, AIG was one company that they bailed out. We're all very familiar, the big insurance giant, and they took stock in the company. Okay? That was their big play, is they got stock in lieu of, in case they had to. And then AIG paid them all back. But, stockholders are the last people paid. Stockholders are the last, at the end of the day, if you own a business and the business goes under, all your creditors are paid first. But in today's world, with bondholders, you are a creditor, and ultimately you are paid before the owners are paid. And so it's important. It's an important decision for the government to be looking at a bond position on a company. It's a stronger position for our government in the Fed, I shouldn't say the government because the Fed, it's a stronger position for the Fed to take into a bond position than a stock position, just because of the creditor ability to grab assets if any of these companies default. Now, what's interesting about this play, though, that kind of puts my ears up a bit, is the fact that it's an ETF, okay? So ETFs and mutual funds, they're your culminations of stocks is really what they are. So they both have, and it is prospectuses, so, compliance, watch out. But the concept that, each ETF has a group of stocks and each mutual fund has a group of stocks. But at the end of the day, when you don't own a specific bond itself, you can't ride it out and personally go after the company. In an ETF, there's going to be ultimately lots of people are going to own the underlying bond. The ETF, the creator of the ETF is going to have to be involved in that, getting the money back story for a defaulting company. So that's interesting. I don't know if the Fed's just saying, listen, we don't want to be in the default problem, and then that's why we're going ETF, so that the ETF itself can be involved with that pain in the butt scenario. That's a huge process. That's an enormous process in the default space, because when you're talking about junk bonds or high yield bonds is really what we're really discussing here, Seth. I don't think our government wants to be in the destruction of companies, or the Fed. I keep mixing the two together, but I don't think the Fed wants to be in the destruction and the dismantling of companies, which is why I think they're going ETF route. What do you think?
That's a really tough question to answer. That's a really hard question to answer. It's what is the Fed thinking? We don't even really know. What we do know is that I think their intention is really to truly help a sector of our economy as a whole. There's different ways that governments can interact, and that's again we're getting involved. We're saying government. I'm saying government now. The Fed can interact in trying to provide stimulus to the economy and different levers in the economy. And this is really one of those things that they're going into thinking, hey, how can we be proactive in elevating or propping up the economy? And I think the ETF is just a more liquid version of traditionally what people have held as independent assets.
Yeah. No, it does. It does create liquidity for sure. I would agree with that. I'm just looking at the fact that they're looking at all these companies that are going to be basically going from being high quality corporate debt to low quality corporate debt just because of the economy. So that's why they're saying we're going to buy into the junk space, because when you start thinking about airlines and cruise lines and all these companies offering bonds, there's all sorts of worries in my head. I just look at this and say to myself, I think some of these companies really make it, but I think some of these companies really fail. And it's just interesting that they're looking at, ETFs. I think that's just to spread risk. But, I think about a cruise line, for instance. Those ships are $800 million a piece or something like that. Those things are enormously expensive. So, when you start, I just think it's all about dismantling. I think they don't want to dismantle companies. I think they want to put that in somebody else's hands. We're going to invest. We'll diversify. Now, the big side of holding a bond is that, like Warren Buffett, who's made loan after loan. I think he loaned $8 billion or something like that to Occidental Petroleum. And I could be wrong on that, but I'm pretty sure he did. But that was like 8% interest rate. You look at these things, you can hold that bond indefinitely. It doesn't matter that the value goes up and down. With an ETF, you're up to what the manager decides what he's going to buy and sell. You can't hold on. You can't hold on to an individual bond inside there or say, hey, I don't really want you to move to that bond. You're stuck with that asset class in that holdings perspective.
So one of the other things I take a look at here is right now on the ticker HYG, dividend yield at the levels that they're trading at, which was roughly $80 a share. Dividend yield at around 5.5%. Sometimes people think just in growth mindset, but this is the part of the bond world where you have a percentage of that bond that is continuing to pay you out over time and holding that until the maturity. This is one of the ways that you can buy into the bond space and not have to hold these tickets until maturity or trade them independently as well. Ready to yield up?
I'm ready to yield on this article, Seth. Go ahead. Next up, we have, will the stock market tumble from this coronavirus low of March 23rd? And, Seth, this article is really interesting. This came from Market Watch. We're always looking for these types of things. We're always trying to understand what's going to happen. We're all looking for that crystal ball. I used to have this thing on our conference room table, and I never thought about it. It was just this thing from this company, and it was a glass ball that had like a world globe on it. It was like etched in it, and it was a company on the bottom. It just was a little flat on the bottom, sat on the center of the table. And I remember one client came in and he goes, "What is this? Your new crystal ball?" And I just started laughing. It was just completely didn't even think about that. I'm sure someone made it to be that. It just was an interesting piece. I don't even know where that thing is anymore. But, people say, hey, what's your crystal ball say to you? And, what we tend to do in this industry is really look at lots and lots of history, lots and lots of data. And we look for articles that provide that data. And one of the things that popped out to me in this article was that since 1928, the Great Depression, there's been 25 bear markets. Now, when you look at that, and you look at the S&P 500 index, and you put all that together, out of those 25 bear markets, 60% of the time, the bear market retouched a lower low. That means that if we were to experience that 60% of the times, that means that 18,210 overnight trading low that we had would go lower again right now, 60% of the time. And that's what a lot of people are talking about. That's a lot of fear that's instilled in our market because everyone knows that, hey, we went from a bull market to a bear market. Now we're in another bull market. And that's when they start talking about the W, like we went down, we got up. Are we going to go down again and create that second leg of the W? Or are we kind of going into a continued bull market? Now, what's interesting about these statistics, Seth, and I thought this was interesting because you brought another article to the table that I thought, combats that whole story. But since 1928 to 1940, 11 bear markets occurred. But nine of those retested a new low, which is a huge, that's, and we're talking almost 90% of the time for about a 12-year period, the market continued to go down after first downtime. So we had a lot of history behind that. And then since then, 60% of the time, it's like 14, 15, so that's another 5 or 6 that we've retested the low out of those 25 since that 9. So it is definitely kind of stagnated in that double test since then. And a lot of that, I think, has to do with the Fed really kind of like easing us through this period, which I think is interesting. But Seth, you had an article you wanted to share on this topic.
Yeah, I was just going to say one of the things that's interesting too around those numbers is 25 bear markets since 1928. That was bull markets. I want to go back and double check. Was that 25 bear markets? Yes, I was right. So that's roughly every 4 years that there's a bear market, if you were to average that out. So when we've talked about in the past, we are overdue this correction. And I think that's, to me, that's kind of an interesting piece of the elasticity of the market. It's like a rubber band. Like the farther that you stretch out that bull market, isn't it interesting how quickly the market responded in that sell-off in February through March 23rd?
Oh, it's been an unbelievable sell-off and then an unbelievable recovery to date. I mean, this is unprecedented.
Yeah. Yeah. So we're kind of in that place where, well, are we going to stretch this rubber band out again, and for how long? We don't know. But fascinating data. So there's a lot of two sides of the coin. How much information is out there in the bear market? Are the bears satisfied yet that they've gotten their due? Are the bulls trying to make another run at it? I mean, we've got all sorts of economists and people that are in the know trying to give their key financial perspective in this. But this one is that basically saying, and again, this is from Market Watch, saying that the markets for March, basically we've tested the lows, and that's it. And we're never going to see those lows again.
Like they're saying forever.
This is professor at Wharton, Jeremy Siegel. And he throws out a comment. I think 2021 could be a boom year. Wonderful. I think there's a lot more information behind why he's saying that he's saying what he could say. But I thought that was one of the most interesting parts of what he was saying here, was that basically March 23rd, folks, that's it. You and I will never see that number again. That's a big statement. But this is a guy that also has qualified a couple of other things, of course, in his history of, calling out different parts of the market. For instance, the Dow 20,000 was one of them in 2015. Dow finished up around 17.5, I want to say, for the year. And Ben and I, guess what we called, I don't know, we're going on 8 months ago. Maybe I think we called the Dow at 30.
Yeah, I think I think the Dow, if we get past the coronavirus fear, I think the Dow hits 30,000 end of this year, beginning of next. I still think we have, because the thing is that the Fed has poured and the government has poured so much money into our economy, probably more than, I don't even know if it's more, but I mean, it's just so much money that offsets everything we're not spending, not doing. So, does the Dow hit? I mean, you've got to remember the Dow is only the 30 largest companies in the U.S. So, I mean, it's not like we're talking about the S&P 500 and the 500 large caps. We're talking about 30 companies. So we base progress on such a small point in the marketplace as a whole. But when you talk about, like, Seth, just to even compound on that, Campbell Harvey, he's a professor of finance at the Fuqua School at Duke University. And
What'd you call me?
I called you the Fuqua. So
I appreciate that.
But he predicted a recession for early 2020 or early 21. He's got basically a perfect record for calling recessions and is betting this one will be over by the end of 2020. I like this guy.
I'm with you.
I like him. I want to like him. I think the rest of the economy wants to like him too. So he is perfect. Well, that's what it says. He's perfect.
Yeah.
But I think we need to really understand that the recession doesn't mean that there's not going to be bloodletting financially in certain areas. It doesn't mean that we're not going to see retail bloodletting all over the place. It doesn't mean that we're not going to see people not eating out at restaurants for a long, long period of time and that a lot of restaurants just go under. But also, the best restaurants, the ones people are willing to take the risk on, are the ones that they like the best, and those are the ones that will most likely survive. Mm-hmm. I think it's scary when you tell a restaurant owner that he can only have 50% capacity because they're trying to pack as many people in there as they possibly can to cover their bills and make money. I mean, this isn't about breaking even. This is, people run businesses to make money. Let's not be foolish here. And, some of these business owners are going to say, it's not worth it.
I agree with you there. I think one of the things that people are right now, what I see happening in the conversations that are going on with people that have our clients that are in the healthcare world, let's say, for instance, what's going on inside of the healthcare world? They're saying to us, hey, we're good. You guys, we figured out how to manage our staff, our situation. We're not to isolate the cases to a certain location and how to work through that. They're ready. They are ready to go back to work, and they've got capacity of their beds. We have people that want to go out and eat. And I think one of the things that's more than likely than not, I think, is that people are going to say, look, I want to go eat at your restaurant. Open a table for me. I don't know that people are going to try to make sure that it's mandated that there's a certain proximity or space, because you're going out into that environment. You're choosing to go out into that environment and do what you're going to do. If you are not in a place where you can make that choice because you've got a health condition, you've got something that's behind the scenes that you should probably practice your life a little differently to protect yourself, that's on you. You are the person that gets to make the choice. This is a freedom that we get here today, folks, that we could go out and do what we want to do and do what we need to do. And I don't think putting that in place, limiting the capacity for the businesses that need to do business is the smart thing. And I think the mindset is there for most of the people that we're talking to. You guys, we have had a great time so far. I hope you agree. It's been fun.
Seth, I'm excited about our next topic, man. I'm excited about our show. We went a little long on news, but it's all good stuff. But man, we're going to talk about
We could keep going.
We could keep going. Real estate, baby. That's what's coming up next. I'm excited for it because why are people not talking about real estate?
Well, we are, and we're gonna in just a few minutes. Stick with us here. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Also, go to yourmoneyontap.com. Check out the new website. There's videos, there's you name it. There's resources for you to help you to take your next step. That's what it's all about. You're listening to Money on Tap. We'll be right back with real estate. Hard assets, folks. That's what we're talking about next.
Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap, your personal finance headquarters. We bring out the professionals' experience and some fun in what we call three-dimensional investing. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We have a new website. It's yourmoneyontap.com. We got lots of great stuff there. Resources on top of resources for you as an individual investor to help you understand what your next step can be. You can also reach us at BrayshawFinancial.com.
So having this conversation about real estate, clearly we're excited about it. With that being said, we need to understand, hey, there's going to be advantages, there's going to be disadvantages to anything that is an investment period. Real estate is an aggressive investment. It is a stance. It's something that is illiquid. Yes, it potentially has some tax advantages in it, but going into the space, we're going to try to uncover what some of the parts and pieces are and what some of the things are that you could potentially participate in the market side as well.
All right. Do you own a home? Right? That's one of the first things everybody thinks of in their terms of their real estate world. Do you own a rental? Okay. And so owning those pieces directly, that's one of the things we would call a hard asset. Okay. It's illiquid is one of the other things that we would talk about around owning real estate. And depending on how you own it, there could be some tax benefits, right? Passive income is one of the things real estate can offer. There's exchanging real estate and going through a process called 1031 that can sidestep recapturing your schedule of depreciation that you've used or the gains, and go through a tax, basically a liquidation of that property into an ownership of another property and not have to pay the taxes. That's what that can provide for you. So there's some different things around real estate that are really amazing and we love, but there's also ways that we can own it in portfolios with our clients without them having to necessarily get a mortgage and go through the qualifying and the sorting out what are the options and how do I buy, and really be that hands-on ownership kind of a model. So how can we do that? And what are the benefits, and what is the landscape that we're looking at when trying to make decisions around owning different pieces in this asset class? That was all I had, Ben. Thanks for listening. Thanks for letting me have it.
Well, Seth, I think the thing about hard assets is they're the one that you look at last. It's the one that people are all excited about. They're talking about whether Warren Buffett wants to own or sell or buy or do this or do that or loan that to an airline or not an airline or a cruise line or an oil and gas company. There's so much stuff that they talk about, which is the high action items. But sometimes the real action happens in the tortoise and not the hare. And that's kind of the thing that we're going to talk about today, because honestly, real estate is one of those things that gets the lowest. It's just not that interesting for a lot of people. It's the tortoise. No one wants to talk about the tortoise. Everyone wants to talk about how fast the hare can run. And so what we want to do is kind of get behind the tortoise a little bit today and talk about how sometimes the tortoise can be the hare when no one else is paying attention to it. In today's world, when it comes to real estate, we talked about ETFs earlier, and ETFs being a culmination of stocks. There's what we call REITs, and REITs themselves have their own ETFs, and REITs are real estate investment trusts, and we're talking about traded ones on the exchange. So we're talking about things that have high liquidity. You can buy and sell these stocks or these ETFs regularly all over the place. But there's a lot of interesting real estate out there. So when we start talking about real estate, we can start talking about things. And when I mention these names and these divisions of real estate, some people's ears are going to go up and be like, I don't know if I want to own that. Like, what about an apartment complex real estate investment trust? Or what about an office property real estate investment trust? Or what about a healthcare hospital real estate investment trust? Or, what about like infrastructure, like 5G infrastructure real estate investment trust? I mean, there's lots of domains in which you can own real estate structures and have exposure either into a sector specifically, like infrastructure and 5G, or you could own just an office property, or you could own just an apartment based. You can focus on A quality apartments with granite countertops, or you can do the B quality that have cabinets that aren't that great, but and what's the occupancy rates of these things, and what's going to happen because of Corona? I mean, some people may not want to own an apartment REIT with all the facts that we got the highest unemployment since the Great Depression going on in America right now. So what about those people who can't pay their bills? Do I want to own an apartment REIT? But what about the hospitals? I mean, we have hospitals that are potentially overrun. We have hospitals that are by no means overrun, and they're laying people off. What is their revenues going to look like for the medical facilities? And what about infrastructure, and how does that look? There's a lot of different programs. I like some of these. I think there's some that are really, really strong and that we've seen. Seth, I'm just thinking about some of the ones that are going through my head as we're talking here. But we've seen apartment programs have 90+% payments on their rents. Now, 90+ is considered a super positive program, and they never have 100% usually. It's not usually 100% occupancy, and it's usually never 100% payments. There's usually somebody that's struggling in the program, and if you have 100% occupancy, it usually means you're not charging enough. So there's a little bit of like balance to that stuff. I think when it comes to real estate and our listeners today, this is an area that has not been highly sought after. We saw a recent rise this last week, which was surprising. But I've been buying REITs and REIT ETFs. I mean, we owned a lot of them last year. I've been buying more this year. I've been buying more as of like a week or two ago, and I've been putting more and more money into them, seeing value and trying to see how these things are going to play out. But some of the dividend yields, Seth, I want to call this show Yield, 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 because some of the yields inside of these REIT programs that potentially look very, very strong because they're so oversold are really strong. I mean, really high. The problem with yields, though, is that none of them are guaranteed. None of them are promissory. None of them are things you can count on. They're determined at different time spans. Matter of fact, a lot of yields sometimes are even borrowed upon by banks to maintain at times, and they can be deceiving. So, we hear these unbelievable yields, but in the reality, you could be buying a failing asset, and that's something to be really weary of. And in a time period like now, where a lot of this real estate, I mean, people aren't paying mortgages, they aren't paying rents, the fear of all of those things and which ones are, going to be successful and survive and which ones aren't is way too scary right now. And I wouldn't start chasing yields. They are attractive, they're interesting, they're eye-popping at times, but don't be suckered in a time when yields just look good, from the standpoint that the stock might be being crushed. Well, that stock could be being crushed because the assets of no value. And that's probably some of the warnings I would really throw out there to people, is that yield is not everything. A yield might not be anything, honestly, and it might be a complete deceiver.
So you mentioned oversold. There were so many places I just wanted to jump in with what you're saying there, Ben. But I think it's important for us to try to add some perspective to what it is that we're saying, because we've worked through a lot of these scenarios and a lot of these pieces here, and we like it because of all these different reasons, and we're excited about it because of all these different reasons. So how do we connect with you right now and help understand what are the parts and the pieces when we're looking in terms of our portfolios or in terms of our clients, what's important? So the market, right, which is, we talked about a little while ago, the market being a rubber band, and it went on such a long bull run that imagine that rubber band being stretched at about the capacity that it possibly can. It snapped back violently because I think of how stretched it was, and because of the kind of the exogenic, which is an exterior to the market, not something that we had in baked into the economy that was failing. This is the coronavirus that came in and swooped down on all of us, and the market said, we don't know what's going on, and it freaked out and it pulled back violently. Okay, so part of what happened in that is all asset classes, that includes the real estate asset class, took a massive hit. It didn't matter if it was bonds, it didn't matter. There's just not any sector out there that didn't experience a hit through this cycle or this pullback in the market. So publicly traded real estate, folks, is just that. Just kind of like the bond piece that we were talking about in those ETFs, right? Because you're not owning that coupon independently for that bond. You didn't go out there and buy it on the market as an individual holding. You bought the ETF, which has a whole lot of stuff in there. And there's an advantage to that, and there's potentially a disadvantage. What are those pieces? Well, in terms of owning real estate, we talk about the liquidity part of it. The ETF and owning those ETF real estate pieces are liquid. They're on the market. They snapped back. They experienced the drop of March. And so those are some of the buying opportunities, but it's a liquid holding. So it's buying an illiquid asset in a liquid holding. That doesn't make much sense. So in pulling back another layer, we can also, depending on our clients, depending on where they're at, there are also ways to hold real estate in illiquid forms as well. A potential advantage to that over the long term is the illiquidity of that asset and the dislocation from market events like we've experienced. And there are reasons for that we like that as well. But right now we're talking about owning real estate in a liquid form and some of the opportunities that are inside of there. And there's certainly, as you take a look deeper, there are some real headwinds for some of these assets as well. There's plenty of argument to be made that these are going to, the underlying holdings in these real estate holdings are going to be hit in different ways, primarily because of rent. And who out there right now can't keep their doors open or can't pay their rent? Because that's one of the ways that real estate works, right? When you have a building out there and that capacity, or that 90% rental capacity that they're that's a healthy number. We like that. 90% of the units are being rented and they're paying their rent monthly. That's how the dividend or the yield works on that backside there to create that cash flow to come through. Now that we've had this event in our economy, how many of these businesses out there are shuttering, and we don't have that rent? So that's the flip side of what we're taking in terms of what we're taking a look at here, and we need to be aware of that as we're taking a look at things.
Yeah, definitely not interested in a retail REIT. I mean, like I'm looking at Simon's Properties. I mean, they're just announced a reopening, and there's all sorts of stuff going on there. But man, I don't have a problem going back to the mall. But I'm also looking at the amount of hesitation going in our economy around this coronavirus and all the things that are happening, and the number of people that don't even want states to reopen that are fighting that. They're definitely not going to the mall. I mean, if they don't want the state to reopen, they're not walking around the mall breathing the cycled air, the air conditioned cycled air in there.
I just had an idea. Is there a way for us to roll out a beach REIT? I think a beach REIT would be where everybody's headed towards right now.
Yeah, beach REIT. That's fantastic. I'm all into the beach REIT, Seth.
Oh, give me a public parks and anything outdoor. Let me have it.
Oh, gosh.
Well, I wouldn't be. There's so many different ways to kind of chop up this. I say chop up, cut out. There's like just you can get very specific in how you own and what you own. That's what I guess I'm trying to say there.
That's exactly where I'm at. I mean, there's a number of these tickers, Ventris, VTR, and SRC, Spirit Realty Capital. These are two REITs that I do currently own myself. They're high risk. There's so much going on in the real estate space, so much speculation. This is not a recommendation. It just happens to be something that's in my portfolio. One of them actually was a spinoff that I inherited from another company. But this is not, again, we have to say this. This is not a recommendation. We are not offering advice here on REITs. We're specifically referencing this Bloomberg article here, Wall Street Game Plans, which ETFs the Fed might buy in May. And the reason that this is such a big conversation is just the historic marker that this has never happened before, that the entire world is changing the way it does financial dynamics in our country to address the financial cascade falling in front of us as we're trying to rebuild our country after a pandemic event, a stay-at-home order, and now all sorts of other things are happening around us. I think there's some really strong opportunities inside some of them. They're not for everybody. REITs still have that, even though they have a liquidity space on the stock market, the amount of risk because of the underlying illiquidity of the actual real estate underneath that does create a complex conversation in a full market crash, right? So, I mean, we've seen, and I think real estate has that tremendously high volatility space that, will dive down in a crisis like this because people aren't really sure how this thing all, pans out when no one wants to buy your ETF shares or your REIT shares. I mean, it's, they don't know what they really want anymore and what they can do.
I think when you're investigating these ideas, if you're interested, I think trying to have some diversity around them as well. And it's kind of like, it's kind of like everything, right? We don't expect everything that we buy to go up 20% in the next year, regardless of whatever the fundamentals are or the economy is going on the economy. We're buying these in different places for different reasons, and we're understanding that these are long-term. This is long-term stuff, folks. And definitely in terms of the risk reward, they're considered on a much higher risk on the scale of what is out there.
What's interesting about O, Seth, and I'm not necessarily a proponent of O, but it is a retail REIT. Since its listing in 1994, it's increased its dividend 106 times, which is phenomenal. That's why it has so much publicity around it. I'm not ready for retail yet. I think for a 5% dividend, I'd much rather go healthcare because I think they all get bailed out. I'd much rather go single box store. I'd much rather go, 5G infrastructure industry. Like those are the key components. I think, like even if they're bad at what they do, they're still going to be okay. Well, another one I'd probably stay away from, and I say I would, but I do actually think I own it, is OPI, which is office property. And it's a well-managed program, but I just don't know. Like even with the management, it doesn't necessarily matter if people are reducing the size of the amount of office space they want. I mean, who's to say that the new normal is just not less office space and downsizing and, hey, we don't need a 30,000 square foot building anymore or a 100,000 square foot building. We're going to downsize. We're going to have half of our workers work from home because they don't want to be in an office anymore. And, that's just the new normal for them. Who knows? I am concerned about office properties. I think retail has a much stronger potential recovery because I think we are a retail economy. I mean, I think malls have died down a lot because going to the mall, parking and carrying your bags around the mall became old. Now we just drive to the store, park, buy, put it in our car, go to the next store, and but that's part of our lifestyle. So I think that doesn't completely die. And what do you think?
Well, I was going to say there's the case for the bears here on the medical properties. Okay, two main things that they're talking about in this realm is pipeline disappears and becomes what's called non-accretive. Okay, disruption of the tenant base causes negative organic growth. All right, now I'm going to go ahead.
You sound like you're speaking Greek over there, buddy.
Yeah, I know, I am. I'm going to try to round it out a little bit here. So, what does that mean? Right? Basically, the bear thesis here is a disruption of the current tenant base. Okay, and that means that people are there's a lot of pressure right now in the medical industry. And Ben, you talked about a bailout. Why would we have a bailout? Well, there's pressure on the medical population right now because they've been shut off from their revenue in many of them. Okay, so that's part of it. There's skilled nursing and senior housing that is a part of it. Okay, and there's certainly we understand why there would be disruption right now in this COVID in that sector. But there's a tenant concentration in these REITs. Okay, because it is just purely in a healthcare segment, and so understanding that is part of what we're talking about. Overall, however, okay, given that if there is pressure and if there is government bailout. Prior to this happening, it looks like it's a strong growth opportunity. And growth comes largely in this sector from global acquisition. Okay, so buying properties. If there's distressed properties, they can buy those at a better value, improve on that. I mean, that's part of a sustainable business practice of a lot of these. And then the high tenant profitability. And that's typically insured through high occupancy, and that keeps that revenue flowing. So that's the offset that typically we're looking at with that. So one of these out there in the healthcare sector is the MPW. Okay, so something to take a look at.
Yeah, that's another interesting point, Seth. I mean, there's just so much speculation. So the question is why do we talk about real estate being the tortoise and the hare? And I think as we wrap up here, I think if you're strategic about this, and you're prepared for dividend fluctuation, but you know that these REITs are going to push out the dividend for lots of reasons why REITs are designed for their tax structures to push those income pieces out to you.
Required by law, 90%.
Yeah.
It has to come out.
They have to push that out. It's not like they can hoard this money. And so that's kind of an interesting structure that allows you to really make sure that you are getting the income from these companies. But if you really believe in the underlying long term, not only are they so far under pressure that the opportunity to collect income while you see recovery, it offers a lot of opportunity that may have still been overlooked a lot. I mean, there is recovery. When you look at some of these REITs we're talking about, there has been some significant recovery in some of them, but it doesn't mean all of them. And it's something to look at. And I wouldn't necessarily just start throwing money at things we're talking about here by any means. But I would say that just the sector itself definitely deserves some attention as an investor.
Yeah, something to remember there is there have been more millionaires created through one mode, and that is real estate. Now, this is not necessarily how those millionaires are created. We're not saying that. We're not saying that you buy these ideas and you become a millionaire. No, it's not how that works. It's just important to note it is a really significant part of American wealth. Understand that.
You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Also, we're in a podcast. You can find us at any of the podcast venues out there. We appreciate the likes and the listens. We're also at Facebook at /3D Investing and Twitter at BFG_LLC. We appreciate you joining us here today, and we hope you make it a great day and a great life. Thanks for joining us with Money on Tap.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.